Okay, everybody, we're going to get started. Thank you so much for joining us today. Today's Lunch and Learn is going to be all about down payment assistance programs and what is available, how to work with the down payment assistance programs, what you should expect for your clients going through this process, and to get a better understanding of exactly what is available for consumers. So we're going to really kind of delve into the different down payment assistance programs. We're also going to talk a lot about what are some of the myths about down payment assistance programs. And we're also going to discuss in detail what are some of the alternative options to down payment assistance. So for many of you who have registered for the webinar today, many of you are in the South Florida area. However, we do have some people from across the state. So I'm going to be talking in both statewide terms and also maybe some more county or city specific options as well. So let's just talk about down payment assistance. So a lot of people think that in order for you to get down payment assistance, you have to be a first-time home buyer. It's not necessarily true. I mean, it is true most of the time and for most of the programs, but there actually is down payment assistance programs available for people who are not first-time home buyers. We're going to talk a little bit about that later in the session, but I just wanted to kind of just debunk that myth from the beginning, because a lot of people think, okay, if somebody's not a first-time home buyer, they have zero options available, and that's not necessarily true. So let's just delve into the different down payment assistance programs that are out there and kind of talk globally about these programs and the process for a second. So every down payment assistance program that is out there, for the most part, has some kind of restriction on either the borrower's debt to income ratio, or how much debt they can have compared to their income, as well as possible income restrictions regarding how much the borrower is making on an annual basis. Now, there are some programs that don't have income restrictions as far as how much the borrower makes on an annual basis. And then there are some programs that don't have debt to income ratio restrictions, but may have income limitations regarding how much the borrower makes. So there's all kinds of back and forths with these programs. They're all designed to make sure that either if it's a program for low to moderate income, that they're really helping somebody with low to moderate income, or if it's a down payment assistance program that has a restriction on how much debt that the borrower can have outstanding, but does not have an income restriction, then they want to make sure that they're being very conservative with how much debt that the borrower can have. So oftentimes we find that a borrower actually can qualify for a higher loan amount without the down payment assistance than with the down payment assistance. So I know that's something that's really kind of unusual or hard to really grasp. Like, why would these programs be so restrictive for the borrowers? It's because they're trying to really promote a very low housing expense for the borrowers. And so sometimes very often we find that with the down payment assistance program, that the borrower, for example, may qualify for about 30% less, 25 to 30% less of a house or a loan or a mortgage or purchase price than without the down payment assistance, depending on the program. Now, a lot of this has to do with the different programs that they pick and the down payment assistance that they get, because if they're getting a large down payment assistance, then maybe that doesn't matter as much. So these are things that we will all discuss with the borrower. When the borrower comes to us, we will explain to them, hey, these are the down payment assistance programs that are available to you. And then if you don't use it, or if you can come up with the minimum down payment, then you will have XYZ available to you. So let's just kind of talk about really quickly a down payment in general, what is needed before we jump into some of these other questions. A down payment for a first-time home buyer with a conventional loan. So that's a Fannie Mae or Freddie Mac loan. Remember, guys, Fannie Mae and Freddie Mac are the same thing. They're both conventional loans. A down payment for a first-time home buyer with a conventional loan is 3%. A down payment for somebody who is doing an FHA loan is 3.5%. Now, notice I did not say a first-time home buyer for FHA. It is a myth that you have to be a first-time home buyer to do an FHA loan. You do not. You could be selling a house and doing a simultaneous closing on a purchase of a new house. You do not have to be a first-time home buyer to get a FHA loan. But you do have to be a first-time home buyer to put down 3% on a conventional loan, as opposed to the minimum down payment if you're not a first-time home buyer, which is 5%. So that's really surprising because a lot of people think, wow, you mean the down payment for a first-time home buyer with a conventional loan is actually lower than an FHA loan? And yes, it's true. It is actually lower. It's actually less closing costs also as well. So there's a lot of benefits to the 3% down conventional program. Anyways, getting back into the different down payment assistance options that are available. So the state has, we're going to talk on the state level first. The state has several down payment assistance programs. We all are very familiar with Hometown Heroes and what the Hometown Heroes program was doing. Just to kind of recap, Hometown Heroes is broken into two different programs. There is a bond program and then there's the non-bond program. Basically, right now, the non-bond program, which is the program that everybody was using, had the higher income limitation. So a first-time home buyer under that program was entitled to 5% or could be eligible up to 5% of the purchase price. And there are certain minimums that are coming into play in reference to those minimums. And they allowed an income limit, depending on the county you were in, anywhere from 144,000 to 156,000, but the income limitation was very high. Okay. And it was a non-forgivable second mortgage. Currently, that program is on hold because they have run out of funding. They're hoping that the state legislator will reenact that program, but currently that program is on hold. Now, when I say non-forgivable, that means the second mortgage that they placed on the house for the down payment assistance needed to be paid if the house was refinanced or sold at any time, and it didn't you don't have to make payments on it, but it was a lien on the property. Currently, the other Hometown Heroes program is still available, which is the bond program. The problem with the bond program is that the income restrictions are pretty tight. And so it's pretty challenging to qualify for that bond program. However, when a client is sent to us, we will run it through all of the different options to see what they qualify for. And then you can also access a lot of this on the state website. For those who have registered for this seminar, we will be sending a follow-up email in reference to the links for you to be able to get more information with some of these programs that we're specifically looking at. So the next program that the state has is something called the Florida Assist Second Mortgage. A lot of people do not realize that this is even available. This is a down payment assistance program that is a 0% interest rate. It is a second mortgage that is not forgivable, so it does have to be paid back. There are income limitations, but for the most part, this is going to assist with an additional down payment to be able to help a borrower to purchase a property. Typically, this program generally works with an FHA loan, but there are some programs available within conventional that this could work with as well. We generally find it working more often qualifying with an FHA loan than with a conventional loan. Then there is an additional program that the state has which is a forgivable second mortgage. So it's basically forgiven. 20% of the mortgage is forgiven each year up to 5 years. So it's a $10,000 down payment assistance. It depends on the loan amount, but it's actually either 3%, 4%, or 5% of the down payment. There are income limitations on this program as well. And it is forgivable as long as they stay in the house for 5 years. There is also another program that the state of Florida has, which is called the Florida Home Ownership Loan Program. It's a second mortgage. It is a actual second mortgage with an interest rate. There is a small payment that is associated with it. There are not as strict of income limitations under this program, and we do need to count the second mortgage in the debt to income ratio. It's usually like a $70 payment. It's something small, but it can be used. So we see that there are several different options in the state that we're able to get as down payment assistance programs. Now, separately from the state, most counties or cities have some version of a grant program. For example, in Broward County, there is a Broward County Home Buyers Assistance Program. Generally, with this program, the loan amount is capped at $568,000. There are income limitations under this program. One of the biggest challenges that we see as a lender are the income limitations that the county and the state put on specifically South Florida. The South Florida area, I think, should have a little bit more leniency in reference to the income limitations versus other parts of the state. For example, a family of 4 cannot earn more than $75,000 a year in order to qualify for the down payment assistance. So this program is very specific depending on your family size. If you have a total of 6 dependents, 2 dependents, 8 dependents, whatever the case may be, it is very specific to the number of dependents that you have. But when we look at a family of 4 and trying to buy a property specifically in South Florida, if we're looking at income limitations of $76,000, $76,800 a year for their income, that's roughly around $6,200 a month, let's say, for a total of, monthly gross. And generally what they're looking to see is that the mortgage payment doesn't go over about 45% of that monthly gross. So they're looking to try to keep somebody in a payment of around $2,500 roughly. These are very rough numbers. So just to give you some perspective, that borrower would qualify probably, depending on the down payment assistance, maybe for a $300,000 property, $325,000 property, depending on taxes and insurance. So just to give you some perspective on how the numbers go back to us. So they say that they'll go up to a $568,000 purchase price, loan amount, but based on their income limitations for a family of 4, it's not realistic to getting even close to that. And that's assuming the borrower doesn't have any other debts. So, if it's somebody who has a household size that's, 8 dependents or something tremendously more, where the income limitation is much higher, perhaps that could work. But you need to keep in mind that a lot of these programs are very restrictive on the income. So you've got to double check to make sure before your borrower gets into all of that, either send them to us or have them speak directly to the county and we can give them the guidance. It's always better to send them to us so we can give them the guidance of what exactly they can qualify for. Then there's a lot of city programs that is a 15-year deferred loan. It's actually called Home Investment Partnership. A lot of people don't realize that the individual cities actually have down payment assistance programs available. I mean, it's some cities you wouldn't even think, like for example, Weston or Parkland, like they even have down payment assistance programs available. Like you wouldn't think that the cities themselves would have these programs as opposed to the county, but actually some of them have some really good programs. Like, for example, there are some second mortgages that are 15-year loans, and the payments deferred for 15 years. And as long as you stay in the house for a certain period of time, some of it may be forgivable depending on the city, or some of it may not. Now, the downside of some of those programs is that if you move or you refinance before the 15-year period, then you do end up having to pay it, but at least it gave you assistance to be able to move into the property. So there's an additional thing through the county that is Home Opportunity Grant. So this is an actual grant for lower to moderate income. Depending on the family size, you may qualify, your borrowers may qualify for this. And what's interesting about this is that the borrower does not need to be a first-time home buyer for this program. So it's called Own a Home Opportunity Grant. The loan amount on this, the cap on it is $392,000. But that certainly might be something that could help somebody. And what's really cool about it is that they don't have to be a first-time home buyer. So if you have a borrower that may qualify from an income standpoint, then this might be something that could help them with their down payment or closing cost. And like I said, for those who have registered, we are going to be sending you guys a follow-up email with the links to all of these programs. So that way you can look at some of these income limitations specifically and see what is available. So those are just an idea of some of the state, city, or county programs. We're going to also now talk about some lender programs. So the difference between the lender programs and the federal or the city or the state programs, or I shouldn't say federal, but the state programs or the county programs, is that we as the lender are able to direct and coordinate the entire thing. When you go to the city or the county for some of these programs, generally speaking, it's a much more lengthy process. The borrower has to submit an application. They've got to go through a pre-approval with us, which is not an issue. We then issue the pre-approval. We give them the direction of what to send to the city. We coordinate with the person from the city or the county. And then at some point, they will be pre-approved or approved. Now, once that happens, they'll have a certain period of time to use those funds. And if they don't use it within that period of time, then they'll go back into kind of like a lotto or a wait list to when the funds are available again. When you're working with us, we have access to many different lender grant programs or down payment assistance programs that are directly from lenders. And these programs are something that we coordinate 100%. So what happens when we coordinate them, you don't have to be concerned about the funds not being available, or you go and you put a property under contract and you're not sure if you're going to make the funding deadline that the county or the city or the grant has. With us, we're able to look at many different options that are available. So we have a program that allows down payment assistance for the down payment itself. We have something that assists with closing costs and the down payment. And then we have some programs that assist with closing cost. We even have a 1% down program with no mortgage insurance. So many of these programs, as I stated in the beginning, have a debt to income ratio restriction. Now, these are not income restrictions. These are debt to income ratio restrictions, meaning that their total debt cannot exceed a certain amount of a percentage of their income in order to qualify for these programs. So oftentimes we'll be able to tell the borrower, hey, based on your income and your debt, you will qualify for a $400,000 loan, let's say, and we'll be able to get your down payment covered. Or if you can come up with your own 3% down or closing costs or whatever we're trying to cover, they may then qualify for a $470,000 loan or a $460,000 loan. But there's a significant difference between what they can qualify for with the down payment assistance programs versus what they can qualify for on their own. So oftentimes we find, especially with the higher prices that we've seen over the years, as prices continue to rise, we've seen kind of a lag between what is allowed with these grant programs and what we feel should be allowed, because really, I don't think it's realistic to have some of these income limitations that they have. And for example, on the scenario that I just mentioned, that there is not an income limitation with many of the grant programs that we work with. The way that they restrict us is with their debt to income ratio. So if somebody has credit cards, car payments, things of that nature, sometimes we will tell them, hey, you could qualify for a down payment assistance if you pay off or pay down something. And then the only benefit to them in that situation is that they're using their money to lower their monthly obligations. And then we're giving them down payment assistance by doing one of the grant programs. There's also, of course, everybody realizes the option of seller paid closing costs. We understand as lenders that this is a much more difficult task to be able to get for you as agents, especially in the Florida market where there is such high demand. But if you do have an opportunity to ask for seller paid closing costs, that certainly will allow the borrower to bring a lot less money to closing. With a FHA loan or VA loan, the seller can basically pay all the closing costs. With a conventional loan, if they're putting down less than 20%, then they're capped at 3% down. More than 20%, they can put down, the seller is capped at contributing 3% of the closing cost. More than 20% down, the seller can pay all or 6% of the sales price's closing cost. So one of the things that is often not talked about with some of the grant programs that are out there, the programs that are lender driven, so the ones that we offer, are sometimes those programs can also offer a lender credit. And actually you can also receive a lender credit even if you're not on one of these grant programs. So it's important that your client speaks with the loan officer, which would hopefully be somebody here in my company, and discusses, can we use a potential lender credit? The reason why is that if we can give the client some type of closing cost assistance to help them avoid having the need for the down payment assistance, or it can be used in conjunction with the down payment assistance to help towards closing costs, then we often find that we're really being in a position to be able to offer the client many more options than, hey, this is the only thing that's available to you. And because we're licensed with 35 different lenders, we know, okay, this lender can give a lender credit versus that lender. In fact, we're doing a loan right now where the borrower could not qualify for the down payment assistance just because they have so much debt, but we were able to cover 2% of the closing cost, 2% of the loan amount towards closing cost. The seller was able to offer 1% contribution, and the buyer is putting down 3%. So we were able to facilitate that to assist the client in being able to get the closing cost covered in that situation. Does anybody have any questions so far on any of the stuff that we just discussed? Nope. Okay, so just to kind of recap what we talked about, the state, the county, the city, all of those down payment assistance programs are great. I mean, some of them are up to $80,000. They're really wonderful, but they have income limitations depending on the household size. Those income limitations are published in their websites or on their websites, and we'll be happy to send a copy of those links out. And you have to work within the parameters of those programs. Remember, like what I said about them having a reservation for the money for a certain period of time. So once the client is actually approved, they then need to be under contract and submit a contract to the program within a certain period of time. They're going to be given 30 days, 45 days, 90 days. It's different with every program. In the event that the client doesn't actually close within that time period, then the client will go back into the line, or will go to the back of the line and wait their turn until the funds are available again. So it's sometimes a little stressful working within that program because it does take some time to go through it. And then once you're approved for it, you have to use the funds within a certain period of time. Then in reference to the Hometown Heroes, we're keeping a very close eye on whether or not the non-bond program will come back. I know there's a lot of talks about the fact that there's still some funds that are being used for that program. They're typically being used for people who had a reservation already, were already in line per se for that program. And if somebody else's transaction fell out, then they may be able to still get the funds. So if you had a borrower that was using Hometown Heroes and now they're not using it, if your loan officer actually put in a request to get in line or make a reservation for the funds, you want to double check with them to see if they're still in line, because they may or may not still be able to get it depending upon how many people fall out of line in that program. So they're just finishing up the rest of the reservations that they had for those funds. And then to recap, there are a lot of lender programs out there that clients can qualify for to either cover the down payment, the closing cost, or to lower the down payment considerably. And those are all programs that we have access to. And there are many different lenders that we represent that will be able to tell you if the borrower qualifies. So one last thing I just want to mention, many programs out there have a minimum credit score. Some of them are 640, some of them are 620, depending upon the borrower. We actually are able to give a lender credit towards closing costs or assisting with closing costs all the way down to a 580 credit score. So they may not qualify for the actual down payment assistance, but we may be able to assist with closing costs in that situation. So that really kind of recaps the down payment assistance programs that are out there. If anybody has any questions, please feel free to enter it in the chat. And I can see I have some questions that were sent to me directly. Okay, one of the questions that we have here is to talk about FHA loans and what is available with the FHA in reference to first-time homebuyers. So as I mentioned earlier in the call, you do not need to be a first-time homebuyer to get an FHA loan. Also, on that same token, I want to mention that we do have down payment assistance programs for people who are not a first-time homebuyer, but are a first responder. Perhaps they're a public servant, they're in the healthcare industry, or healthcare field, they're in education, they're a teacher, they're perhaps somebody who's a veteran that doesn't want to use their VA loan. We do have programs available for people who previously owned a house and still want some type of down payment assistance. So that is something that's available for certain types of professions, certain people like veterans, for example. Okay, let's see. We have another question here. Can you use the down payment assistance with closing costs assistance from the seller? Yes, you can use down payment assistance in addition to a seller credit. Now, what's important to know is that the seller credit cannot cut into the required down payment. So for example, let's say you're doing a down payment assistance, or we're helping somebody to get a down payment assistance program where it's covering 2% of the 3% down payment and they have 1% left. And you as an agent negotiate a huge seller credit and you've got all this extra money left. Pardon me. That extra money would actually have to go to a price reduction on the house as opposed to going towards the buyer's down payment. If the buyer is required to bring a certain percentage to closing, the seller's contribution cannot interfere with that amount. So the buyer still has to bring $3,000 or 1% of 300,000 or 1% of whatever the sales price is. So if you have too much of a seller credit, then you would just end up partially lowering the house and changing the seller credit. So that way it doesn't interfere with the buyer's down payment, because it can never, ever, ever go towards the buyer's down payment. It's just not allowed. If there's a minimum that the buyer has to bring, then the buyer has to bring it. Conversely, not conversely, but on the same token, if there's down payment assistance where the entire down payment is being covered by one of these programs, and you have so much closing costs left that there's actually a credit left to the borrower, even though the borrower is not putting any money down, because you guys just by some miracle got this huge seller credit and we have down payment assistance, that money cannot go to the borrower in the borrower's hand. In that case, again, there would either need to be a sales price reduction, or there are some things that it could go to, like clean energy programs that can be financed at closing. A lot of people don't realize that there are clean energy programs, for example, rolling in the cost of a new air conditioner or things of that nature. There's certain programs that work in conjunction with FHA that can be allowed. Okay, do we have any other questions regarding down payment assistance? Let's see, we do have a question here. Is there any down payment assistance for jumbo loans? No, there are not. The current limit for jumbo loans is temporarily $750,000 or more is a jumbo loan, or 751 or more. We're waiting for the FHFA, which controls Fannie Mae and Freddie Mac, to announce the new loan official limits for 2024, and those should be coming out soon. Let's see, is there a loan amount? Here's another question. Is there a loan amount limit for FHA? Yes, there is a loan amount limit for every county for FHA, but depending on the program that the borrower picks, there is a limitation also for the loan amount depending on the down payment assistance program. Okay, we've got another question here. Can a borrower take a second mortgage? Okay, that's actually a really great question, because the answer is actually yes. Depending upon the borrower, we can actually assist them with closing with 2 loans at once. So let's say somebody wants to put down 20% or wants to have the flexibility to not have mortgage insurance. Or let's say, for example, in many cases, could be a condo that could need a 25% down payment to avoid a full condo review. We actually can get them a second mortgage that closes simultaneously with the first mortgage, so that they could put down 10% or a lower percentage, not have mortgage insurance. They'll have a line of credit that closes at the same time, and they can pay that line of credit off at any time. They can pay it down to 0 and re-access it and have it for when they want it for emergencies. Sometimes this is a good strategy for somebody who might be selling a house. I know this is a little bit outside the down payment assistance topic, but for example, sometimes people are selling a house and they're going to sell it after they close on the new house, and they don't really want their permanent mortgage to be more than a certain amount. So this is a good strategy to be used for that. That's a great question. Okay, do we have any other questions? I think that wraps it up. Last call for any questions. Nope. So the bottom line is if you guys have a client who needs down payment assistance, or you want to see if they have any down payment assistance available to them, because remember, if you have a client that you've been told by another loan officer that doesn't qualify because their debt is too high, what if we got them some down payment assistance and then they used the money they had for the down payment to pay off some debt? See what I'm saying here? This is a strategy that could potentially be used to help a home buyer that didn't think that they could qualify to be able to qualify. So for all of our really neat tricks and strategies and financial planning in reference to mortgages and how we can help your clients, please reach out to us. We've got 15 loan officers with a lot of years of experience, and hopefully we'll be able to assist you and your clients in the future. Thank you so much for jumping on this Lunch and Learn. We certainly hope to see you guys next week, where we're talking about investor cash flow loans, which will all be about investors purchasing properties and mortgaging properties and corporations. A lot of really great information next week. So if you haven't had a chance to register yet for that, please do. And thank you so much for attending, and have a great day, everybody.